Let me share the exact blueprint I rely on to navigate the markets daily. Back-tested across thousands of setups, it isn't a magic wand for overnight wealth, but a lens revealing the market's true mechanics. The beating heart of this strategy is elegantly simple: supply and demand. Demand is the birthplace of a massive upward surge, while supply is the launchpad for a violent downward plunge. You want to position yourself exactly where institutional giants execute their massive orders, finding the hidden footprints where the big banks step into the arena. Spotting these footprints is simple once you know how. Locate the last quiet candle right before an explosive move, mark its lowest to highest point, and let the waiting game begin. You patiently wait for the price to return to that zone, execute your position, and let probability do the work. But there is a massive illusion lurking. Imagine opening TradingView and staring at a chart after a huge rally. You don't just see one origin point, you see three distinct resting phases. Three areas of demand stacked like stairs. Which one do you trust your capital with? Not knowing the answer is the difference between falling into a trap and catching a flawless reversal. Let's say the top two zones on that staircase are imposters. They are fake demand zones, carefully engineered to look like safe havens, persuading eager retail traders to buy in early. In reality, these traders are just serving as liquidity. Their trapped money becomes the fuel used to drive the price down to the real foundation, the lowest stair at the bottom. And that is where the true reversal actually happens. Now, you might be sitting there thinking that you should basically just pick the lowest zone because it obviously has the highest probability of bouncing up. While it's true that snatching up lower prices is generally a trader's dream, the absolute lowest zone isn't always the victor. Imagine visualizing a chart with a deep V-shaped drop. On the way down, it created two ledges. If you stubbornly waited for the price to drop all the way to the absolute bottom ledge, you would have been left behind. The price simply tapped the higher, stronger ledge and rocketed upwards, leaving you empty-handed on the sidelines. So, how do we decode the chart and decipher which ledges are concrete and which ones are made of glass? The secret lies in a single word: inducement. Inducement is exactly what it sounds like, an illusion designed to persuade you to make the wrong move at the worst possible time. When we spot an inducement trap on our charts, our odds of locating the true, strongest zone skyrocket. The most foolproof way to spot inducement is by hunting for liquidity pools. And the simplest form of liquidity comes in the shape of equal highs or equal lows. Whenever the market paints a perfectly flat floor, where the price bounces off the exact same low price 2 or 3 times, you can bet there is a massive pool of stop-loss orders resting just beneath that floor. The algorithms that drive the market are practically programmed to hunt those stop-losses down. Because institutional players need massive liquidity to fill their huge orders without experiencing slippage, they push the price below that perfectly flat floor to trigger everyone's stop-loss. Since those stop-losses are essentially sell orders, the institutions effortlessly absorb all those sales to fuel their massive long positions. They engineer panic to get a better price. Let's visualize this on a chart. Picture a strong, aggressive rally, but right before that rally took off, the price spent hours moving sideways, bouncing off a perfectly flat, horizontal floor, creating equal lows. This tells a story of a mountain of resting liquidity directly beneath that consolidation. As the price eventually drips back down to test this area, hordes of retail traders will confidently enter, convinced they've found a strong support zone. They'll dutifully place their stop losses just a few pixels below that flat floor. The market will often throw them a bone with a tiny, hopeful green candle bouncing upward before viciously turning around to smash through the floor, sweeping all that liquidity. The price plummets through this inducement zone and drives straight into the real powerhouse hidden just beneath it. But the market doesn't always hand you textbook setups. Sometimes, identifying the true zone requires looking at the sheer force of a move by identifying breaks of structure. Imagine a chart where the price is struggling against a heavy ceiling of resistance. Suddenly, a demand zone forms, and the price explodes upward, violently shattering that ceiling. That tells us there was immense, undeniable buying power originating from that specific origin point. Enough power to break the structural architecture of the chart. But what if the story was different? What if a higher demand zone tried to break the ceiling, but ran out of steam, forming a weak lower high before falling back? Meanwhile, a slightly lower zone was the one that originally possessed the institutional backing to shatter previous structures. Even though one zone sits higher up on the chart, the one that successfully broke the structure is undeniably the stronger zone. Our third trick for uncovering the ultimate zone involves fair value gaps. Picture a chart on TradingView where a massive piece of news hits and a three-candle sequence prints. The middle candle is so massive, so aggressive, that its body leaves a giant void on the chart, an empty space completely untouched by the wicks of the candles before or after it. That void is a fair value gap. It's an area where the price simply skipped over due to sheer momentum. The market hates a vacuum. It acts like a magnet, and the price will almost always want to drift back, fill that empty space, and then resume its overall trend. Knowing this natural magnetic attraction, we can use it to filter out bad trades. Let's say you are looking at a downward trend and you spot two possible areas of supply where you might want to sell. Upon closer inspection, you notice a massive, unfilled fair value gap hovering right above the lower zone. Because the price is magnetically drawn to fill that empty space, it has no choice but to smash right through the lower zone to reach it. Instantly, we can discard that lower zone. It's not a stronghold, it's merely a speed bump on the way to the magnetic void. We have now crafted a master formula for reading the market's true intentions. It requires us to find inducement zones built on flat, equal highs and lows, designed to trap impatient traders. Identify zones that possess the sheer force required to shatter structural ceilings and floors, and spot fake zones that sit dangerously in the path of a magnetic fair value gap. Let's apply this narrative to a mental exercise, starting with an uptrend scenario. Imagine a beautifully structured uptrend, climbing step by step from the bottom left to the top right of your screen. Because the tide is rising, we are only looking for resting points or areas of demand to join the wave higher. You trace the chart back and find three separate ledges where the price previously exploded upward. Which one is the real deal? Right away, you notice a glaring fair value gap sitting directly above the middle ledge. The market will inevitably want to fill that space, and to do so, it will slice right through the highest ledge. So, the top ledge is instantly disqualified. That leaves the middle ledge and the bottom ledge. You look closely at the price action surrounding the bottom ledge and notice that when the price bounced from there, it barely limped upward, failing to break the previous high peak on the chart. However, the middle ledge was the origin of a massive surge that effortlessly shattered the previous high. The middle ledge is the true institutional footprint. You wait for the price to float down into it, you enter, and you watch the market respect the true structure. Now visualize a downward reversal. A market that has been climbing for weeks suddenly prints a sharp, aggressive plunge, signaling a reversal to the downside. You are now a predator looking for areas of supply to sell short. You scan the drop and see two distinct plateaus where the price paused before dropping further. Both plateaus successfully broke the structural floors below them. But as you zoom in on the lower plateau, you see that right before it dropped, the price chopped sideways, creating a perfectly flat ceiling of equal highs. You immediately recognize the trap. Retail traders are going to sell there, hiding their stop losses just above that flat ceiling. You refuse to take the bait and choose to wait. The price slowly crawls up to the lower plateau. It hesitates, tricking early sellers into thinking they are right. Then, a sudden, violent spike upward shatters the flat ceiling, triggering all the stop losses and grabbing the liquidity. The price drives perfectly into the upper plateau, the true supply zone, before rolling over and crashing to new lows. Finally, let's picture a cascading downtrend. The market is cascading down your screen like a waterfall, and you identify 4 separate resting zones where you could potentially sell short. It looks like a staircase of 4 steps descending from a peak. You look at the first step down from the current price, and it rests right against a cluster of equal highs. It's a blatant trap, as the price will naturally want to surge up to sweep that liquidity, meaning it will smash through that first step. You look at the second step. It's sitting in no man's land, but because there is so much resting liquidity just beneath it from the first step's trap, it too will likely be collateral damage as the market surges upward to collect orders. That leaves the third and fourth steps near the very top of the waterfall. You inspect the third step, and again, you spot a perfectly flat double top pattern resting right against it. It is yet another inducement trap designed to build a pool of stop losses. By process of elimination and reading the market's psychological warfare, you know the fourth step, the highest peak, is the true institutional fortress. You watch the chart unfold as the price rallies, blasting through the first step. It reaches the second step, hesitates to trap the impatient, and then surges again, using their liquidations as fuel. It rams into the third step, swallows up the stop losses above the double top, before finally exhausting itself right at the threshold of the fourth step. You calmly enter your short position at the true origin point, place your risk parameters sensibly, and watch the market respect the true mechanics of supply and demand. Liquidity traps, structural breaks, and magnetic voids are the keys. Stop looking at the market as a series of random wiggles on TradingView and start reading the story of where the institutions are forced to leave their footprints. Master this perspective, and your understanding of the charts will never be the same.